Howdy. Now that you have an understanding of how product costs are recorded in the records for the manufacturer, you can now begin to understand how they affect the income statement. So let's look at cost of goods sold, because that's how product costs affect the income statement. So let's review for a minute. How do you compute cost of goods sold for a service company? Well, that's easy. There is no inventory, so there is no cost of goods sold schedule. You won't find cost of goods sold for a company that is purely a service company. Now let's review what you learned in your first accounting class. How do you compute cost of goods sold for a merchandising company that is a retailer? And if you'll remember, you prepared a schedule that began with beginning merchandise inventory. You added to that purchases of merchandise inventory to get cost of goods available for sale. You then subtracted ending merchandise inventory and you got cost of goods sold. So this is a basic schedule you've learned before. We're going to have to adapt that though when we start to look at a manufacturer. So look at this schedule and identify why there might be problems. First of all, you see beginning inventory. Would we start with beginning direct materials, beginning work in process, beginning finished goods? There's multiple inventory accounts. Purchases would include things like purchases of materials, but also purchases to pay for direct labor costs and other overhead costs. So in other words, it's much more complicated for a manufacturer to determine their cost of goods sold. Now, cost of goods sold for manufacturing companies, basically what you do is you first compute cost of goods manufactured, and then you compute cost of goods sold. And you'll see that this cost of goods manufactured is really like what the retailer purchased. Now, when we do this as a memory tool, because you will need to remember these schedules for the exam, these schedules can be broken into 3 similar schedules to help you remember them. And the memory tool is that for each of the 3 schedules, which we're going to see in just a minute, include direct materials used, cost of goods manufactured, and cost of goods sold. Each of these 3 schedules can be identified as having the same basic format. And that format is you start with beginning inventory of some sort. So for direct materials used, of course, it'll be beginning direct materials. Then you add the current cost related to that inventory. Then you subtract the ending inventory, and that will give you one of the 3 schedules. Now there are some subtotals in between if you want a nice looking presentation for the schedule, but this is the basic computation. Beginning plus current cost minus ending inventory. All right, let's take a look at the 3 schedules. The first one is direct materials used. Now, if you'll turn to that page, you will see this schedule, beginning direct material inventory, and the current cost related to direct materials is purchases of materials, so we will add that. That will give us cost of materials available for production. So it's what we could have used in production. Minus ending direct material is equal to direct materials used. So you can see that again, the basic schedule is beginning direct material inventory plus purchases of materials minus ending direct material inventory, and you have the first computation, direct materials used. The second schedule is called cost of goods manufactured. Sometimes it's called cost of goods completed. We're trying to identify the cost of the inventory that was completed during the period. So we'll start with beginning work in process inventory. That is the inventory that we work on. Now the 3 costs that you add to work in process inventory, if you go back to our coverage, we said we increase work in process for 3 reasons. That's for direct materials used during the period, direct labor cost incurred, and overhead applied. So notice that it is not actual overhead cost, it is the manufacturing overhead applied, the reason that you debit work in process. We will then subtract ending work in process inventory to get cost of goods manufactured. Now, a couple things to note before we move on. This direct materials used will be from the first schedule, from the direct materials used schedule. All right, so those two schedules combined make up cost of goods manufactured. Then when we look at Schedule 3, which is cost of goods sold, we will think about what inventory do we want to start with. So you ask, what inventory do we sell? We sell finished goods. So we'll start with beginning finished goods inventory, and we want to add to that the increase in finished goods over the period, which is the cost of goods manufactured. This will tell us the cost of goods we have available for sale. Then we'll subtract ending finished goods inventory to get cost of goods sold before adjustment. So once again, up to now, this schedule starts with beginning inventory plus current cost related to that inventory minus ending inventory. And the inventory at hand is the finished goods. Now also think back to what do we adjust cost of goods sold for each period. Hopefully you remember that that would be for the under or over applied overhead. So if it's under applied, we'll add it. If it's over applied, we'll subtract it, and that will give us cost of goods sold after adjustment. Just a couple of notes again. Cost of goods manufactured is from the cost of goods manufactured schedule. The cost of goods sold after adjustment is what will go to our income statement. All right, when we're going to take these three schedules and look at an example. To demonstrate how to prepare the cost of goods manufactured and cost of goods sold schedules, we're going to use example 3 in your lecture notes. You are given the following information for Allen Distributors, a manufacturer and distributor of frozen desserts. First, we're given the beginning and ending inventory balances for direct materials, work in process, and finished goods. We can see that direct materials went from $20,000 to $25,000. Work in process inventory started at $30,000 and ended at $50,000. Finished goods inventory started at $40,000 and ended at $75,000. We're then given some current information that happened during the period. Sales were $400,000, direct materials purchases $40,000, direct labor costs $100,000, rent expense on the selling and administrative facility was $4,000, sales commissions $65,000, utilities expense for the selling and administrative facilities $1,000, administrative salaries $80,000, applied manufacturing overhead costs $85,000, and actual manufacturing overhead costs were $80,000. Now with this information, we're given enough to compute direct materials used, cost of goods manufactured, cost of goods sold, and net income. So since we're going to prepare the income statement, notice that we were given sales, we'll be computing cost of goods sold, and we can see here we would want to identify our period costs. That includes the rent, the sales commissions, the utilities expense, and the administrative salaries. Those are our period costs, and so they won't come into play until we prepare our income statement in requirement 4. All right, turning back to your page where you see your schedules, you see beginning direct materials, add direct materials purchases, you will get cost of materials available for production, then ending direct materials inventory to get direct materials used. So I'll just be filling in based on what we were given. We were told beginning direct materials inventory $20,000. Purchases of direct material $40,000. This means that we had $60,000 of materials available for use in production. But since we know that there were $25,000 worth of materials inventory in the storeroom at the end of the period, we must have only used $35,000 of direct materials. Once we've computed that, we can prepare Schedule 2, which is cost of goods manufactured. Now, when you look in your notes at Schedule 2, you'll see that this is really an analysis of the work in process account. Beginning work in process, plus the 3 reasons you debit work in process during the period: direct materials used, direct labor, and overhead applied. We then subtract ending work in process inventory to get cost of goods manufactured. So once again, just filling in what we know. We're told that beginning work in process is $30,000. We calculated direct materials used to be $35,000. Direct labor cost is given as $100,000, and overhead applied is $85,000. Do note that we're using the overhead applied because that's what's assigned to the work in process account. All right, so our current manufacturing costs total out to be $220,000. That's the direct materials used, the direct labor, and the overhead applied. We then subtract our ending work in process inventory, so we have $30,000 of beginning, $220,000 added, minus $50,000 in ending work in process, and so that means that we had $200,000 of cost of goods manufactured. This is the cost of the goods that were completed during the period. So given that, we can go and prepare our cost of goods sold schedule. This is what you see before you in your Schedule 3, cost of goods sold. Beginning finished goods inventory, we add cost of goods manufactured because that's what we added to finished goods during the period. This tells us cost of goods available for sale minus ending finished goods gives us cost of goods sold before adjustment. So up to that point, this is really just an analysis of the finished goods account. You could prepare a T account to analyze that. But we do have to adjust for our under or over applied overhead to get cost of goods sold after adjustment. All right, beginning inventory is given to be $40,000. We computed cost of goods manufactured to be $200,000. That means that we had $240,000 of finished inventory available for sale. But since we ended with $75,000 given in the problem, we know that we didn't sell everything. Our cost of goods sold before adjustment computes to be $165,000. We will then adjust for the under or over applied overhead. So we will need to go and look at what was given for that overhead. So off to the side, you'll want to maybe prepare a T account for manufacturing overhead and recall what we were told. Applied overhead, $85,000. Actual overhead, $80,000. Actual overhead costs go on the debit side, and applied overhead costs go on the credit side. We actually incurred $80,000 of overhead cost. We assigned $85,000 to inventory. This means we have a $5,000 credit balance. We have over applied overhead cost. We assigned $85,000 to inventory. We should have assigned $80,000. We have over assigned cost. That means when we go to finish out our cost of goods sold schedule, we are going to need to reduce our cost of goods sold. We over assign cost, we subtract the $5,000, and our cost of goods sold is now $160,000. Now this is what will go into our income statement. And there you'll have to prepare your income statement. We'll just use our traditional format for now. But remember, when you're preparing that income statement, cost of goods sold after adjustment is what goes to the income statement. So always adjust for under or over applied overhead before you prepare an income statement. The income statement using the traditional format will look like this. Sales, those were given. We computed cost of goods sold. That will give us our gross margin. minus operating expenses, and this will give us our net operating income. Sales were given to be $400,000. We computed cost of goods sold after adjustment to be $160,000, so that leaves us a $240,000 gross margin. Operating expenses, we labeled those, and they come out to be $150,000. But if you're looking at your information, you'll see that that's made up of the $4,000 of rent for the selling and administrative facility, $65,000 of sales commissions, $1,000 of utilities expense for the selling and administrative facility, and $80,000 for administrative salaries. Totals out to be $150,000, leaving net operating income of $90,000. That concludes this example. So now you understand how to record product costs, but also how you fit them into the balance sheet and income statement based on this. So you can get some extra practice by doing your homework and the other example found in the problems section of your Chapter 2 lecture notes, which we'll do in class. See you then.